the Bank of England is implying that these emergency measures are temporary. But, you know, we had some of these measures put into place here in the U.S. and across the world back in 2009, 10, 11, and they became kind of permanent. So what exactly is the market read on whether or not volatility is going to cause the Bank of England to keep its intervention program longer than expected?
Hi, Dom. Good to be with you. Well, the road to hell is paved with good intentions. Look, we're looking at the symptoms of a larger disease, which is financial instability globally, coming about by an incredible velocity in rate hikes across the board, especially driven by the Fed. We came out of a system where we've just doubled debt to GDP in the United States since 2008, yet we now find the 10-year yield at levels of 2008. And the velocity of that move is simply not sustainable without breaking something. We went from free money to now extreme restrictive policy. And we see what happens in England. It's causing problems, not only because of yields, but because of the strength of the dollar. And so the system is actually fairly fragile. And so I think the message here is that central bankers are desperately trying to fight for credibility on the inflation front, but at the same time are risking that something larger breaks. And so that is kind of the biggest risk out here, that central banks are moving so fast, especially the Fed, that they're not waiting to see what the actual impacts on the economy are, and then they're over-tightening. So going from over-loosening to over-tightening, and then before you know it, the disease, inflation is cured, but the patient is dead, and you end up with a larger, deeper recession.
I mean, that's harsh, though, right? That the patient hopefully isn't going to die, because that implies the market and the economy are doomed for some kind of really bad, fiery pit of inflationary-driven kind of volatility. I wonder, though, if you're looking at this, we know over the long term things have to be fixed and work themselves out, but these are, at least downturns are being viewed as opportunities for some folks. Is there more downside left in your mind for the U.S. market? And if so, how much before eventually we have to assume things recover?
Yeah, I mean, I'm with you on this. I mean, inflation to me is a temporary issue. The question is how it's going to be solved in terms of the tightening aspect. Technically, actually, ironically, as markets have been under tremendous stress here, technically, I see this all positive here. I mean, what is required, and it's been the same issue, we need to see some relief in the data to drive down expectations. Whereas oversold structurally, as we've been at the 2020 bottom or 2019 bottom, sentiment is bad as during the financial crisis, and so is positioning. So ironically, given all this, we're still holding in there. I do see some more downside risk if we don't get any relief on CPI or PPI this week. Then I can look at 34.97 to 35.40 in terms of a general next level support level. But if you do get relief, i.e. on the 10-year yield and the dollar, based on where we're set up with positive divergences, we can have a massive meltdown. I hate to be so binary about this, but this is kind of the cliff edge we're at the moment. The market is thirsting for relief. And if he gets that relief, then things can look bright very quickly. So, but that's the risk, right? Because if you don't get that relief, then things can still get tougher here in the near term.